This is the fourth video of 4 on the portfolio strategy topic. Today what I want to do is do what we did the last video, starting from there where we created an efficient frontier, a strategy portfolio, and then discuss some of the issues that come up with using the efficient frontier. I want to start off by having you assess the history of the recommended portfolio versus what is expected. And then we'll talk about some of the issues with the inputs to the efficient frontier, in particular standard deviation and correlation. And then I want to talk about some things that you might do to edit or change how you approach the efficient frontier, coming up with what we talked in the last session on a tactical allocation. This session will go back to the Excel spreadsheet we used last video, and I want to start by showing you a sheet in that spreadsheet, and it's called Historical VAR. VAR is value at risk. It's a measure of risk similar to standard deviation. It's only slightly different, but it is insightful. And so what I have here is I start off with the portfolio that I had, my current portfolio, and then the portfolio that the efficient frontier gave me. This is the portfolio your wealth manager may be recommending to you. I have a risk tolerance. Risk tolerance, what that means is what part of the risk distribution do I want to look at? And so 1% risk tolerance says I want to know 1% of the time how much could I lose or more. So it's that downside risk. So 1% risk tolerance is pretty common, especially for older people. The lower your risk tolerance, the more worried you are about risk. So I want to know, one time out of 100 years, how much could I lose? Similar to what you might have heard like with floods, a 1 in a 100-year flood. So here we're looking at a 1 in 100-year market event, stock markets, bond markets, whatever else you have in your portfolio. How much could you lose 1 out of 100 years? So it's an interesting approach. The spreadsheet is set up to do all of that. The only number you would change would be the 1%. If you're a young person in your 20s, then maybe you would use a higher risk tolerance like 5% because you're willing to take more risk because you have more time to build up your portfolio. You can take all of those fluctuations as you're building up your portfolio. Or someone that's near retirement might use 1% or even less just to say, hey, I'm really worried about rare events because I don't have time to build my portfolio. I'm retiring soon, and so will not be able to add more to my portfolio, so I can't take a large loss all at one time. So I have it set up at 1%. And what I have down here is that current portfolio I started with and what the wealth manager is recommending based off of the efficient frontier. And I have historical data, and I have my assumptions that I used, which is my forecast, my data going forward. And I go back to 1988, so about 25 years of data. And I want to know what was the return of my current portfolio versus what you're recommending, because the wealth manager said, hey, we ran the sophisticated model. We're recommending that you change from this portfolio here to this portfolio. And we're recommending that because, as we saw in the efficient frontier, we think it's going to have a higher return at the same level of risk. When we look at the historical data, we discover quickly that our current portfolio actually had a higher return than what the wealth manager is recommending. So I believe anytime you deal with a wealth manager, you should ask this question. You should ask it for 3 reasons. One reason you want to ask them, how is what you're recommending, how would it have performed historically? I'm just curious. You want to ask that just out of curiosity. I just want to know. I'm not saying it doesn't make sense that what you're recommending, you expect it to do better in the future than it's done in the past because things have changed or whatever your assumptions are. I'm just curious. And then you say, well, it's interesting. You're recommending a portfolio you believe has a higher return going forward, but has actually had a much lower return historically. Why are you doing that? Why do you believe this portfolio going forward will have a higher return? And that's the second reason I want you to ask this question. is most wealth managers are not able to provide this data. If you're dealing with a wealth manager and they say, hey, here's a portfolio we recommend, we want you to move from your current portfolio to this portfolio, and you ask them, how would that have performed the last 25 years? If they cannot answer that question, they're not selling you advice, they're selling you a product, a prepackaged product they're getting from some home office that's produced all of these models, and they don't really understand them. All they're trying to do is sell you something. And if they can't understand something at the level to answer this basic question, then they definitely should not be your advisor. The third reason is that most wealth managers cannot explain the difference. So most can't even provide the data, and then if they do provide the data, they can't explain why has this portfolio that I currently have done so much better than what you're recommending. Now in this case, it's probably because we're going from a very low allocation to non-US stocks to a high allocation to non-US stocks. We're going from 10% in developed and emerging market stocks to 40%. Your wealth manager believes non-US stocks will do well going forward, but they have not done well the last 25 years. They've actually done quite poorly, especially relative to the United States. Any change where history is very different than what their assumptions are going forward is going to cause these type of disruptions. And you can see why wealth managers don't like showing you this, because it's very hard to explain. Now, if you look at the assumptions say the recommended portfolio will outperform what you currently hold, even though that's different than history. So I'm asking you to ask your wealth manager to provide all of this information and then explain it. The second part of this question is on risk. Remember, our recommendation was a portfolio with a higher return with the same level of risk. You can see the risk is about the same. It's slightly different because of the way the value at risk is calculated, but it's essentially the same level of risk. You look historically, you can see 1% of the time, your current portfolio has lost close to 34%, but the recommended portfolio only lost 31.6%. So you can see this is very awkward for the wealth manager. They're saying move to this new portfolio because it has a higher expected return at the same level of risk. But then you look at history, and the recommended portfolio actually has lower historical returns, but also lower risk. That is not uncommon mainly because the U.S. stock market has so dominated the world, and most wealth managers don't believe that will be true going forward. And there's probably some truth to that. There's probably some truth that the U.S. stock market is somewhat expensive relative to these other markets. A good way to see if you have a wealth manager that actually knows what they're talking about. Next, I want to talk about standard deviation and correlation. Remember, standard deviation was the input into the efficient frontier on a measure of risk, and correlation was the input into the efficient frontier to understand diversification, how well one asset class helps diversify another one. So the first issue I want to talk about is how unstable standard deviation and correlation are. This shows you standard deviations of major asset classes over time. Higher means riskier, lower means lower risk. You'll notice bonds at the bottom are very low risk assets, fairly stable over time, below 10% risk. But you'll notice developed market stocks and U.S. stocks, and really all stocks, have very unstable standard deviations. What you notice especially in years like 2000, where we had a major stock market crash, standard deviation jumped. In 2008 and 9, where we had the financial crisis, risk jumped again. We saw some other high risk increases due to the Tokyo earthquake and other things going on. And then in 2020, we saw a big jump in risk related to the pandemic. So you can see standard deviation jumps during a crisis. In the efficient frontier model, we only have one input for risk. We don't have multiple inputs. So I have to pick one number to represent the risk of each of these asset classes. For bonds, maybe not so difficult. I'll probably use 5%. But for other asset classes, if I use the high number, the model would never allocate to that asset class. If I use the low number during periods of very high stability, then the model is going to love that asset class and put me 100% almost in that asset class because it just looks like it has very low risk. If you notice large cap value stocks here in the orange, its risk, standard deviation, actually dropped below 10% for a good period of time. And so if I put that low risk in my model, it's going to love large cap value and give me a huge allocation to that particular asset class. Same issue with correlation. If you look at correlations over time, they're very unstable. What you'll notice is correlations tend to be very low during very stable times where asset classes somewhat do their own thing, but correlations tend to jump during a crisis, which is really bad because what that means is you want low correlation so you have more diversification, so a loss in one asset class doesn't hurt you because you'll have a gain in another. Unfortunately, with correlations rise during a crisis, which means during the time where you most want diversification to help you, that is when it helps you the least. And again, with the model, we only have one correlation number between each combination of each asset class. I can only use one number, and yet you can see there's numbers all over the place. Probably the most important number here is the number related to bonds versus stocks. These are all correlations to U.S. large cap stocks, and you'll see with bonds, the correlation is sometimes positive, so they somewhat move together, but sometimes negative. There are times where bonds are a great diversification for stocks. So are bonds positively correlated to stocks, or are bonds negatively correlated to stocks? I like to ask my risk management class that question, and so my answer is yes. Yes, they are. They're both highly correlated at times and lowly correlated, even negatively correlated at times. You can see here recently I took the 10-year Treasury versus the S&P 500, so one particular stock market and one particular bond. And you can look at these rolling correlations back to 1963, and you can see during the 70s you saw a big jump in the correlation between stocks and bonds, and that high correlation between stocks and bonds lasted from the 70s into the 90s. And then after the 90s, you see negative correlation between stocks and bonds. But then you notice here recently, the correlation between stocks and bonds has gone positive again. And why is that? And the reason for that is, this is extremely important, is that stocks and bonds are positively correlated when markets are thinking about inflation. So in the 70s, we had high inflation. Everybody was worried about inflation. In that case, both stocks and bonds did terribly. It was a terrible time to be an investor in the 70s. There was almost nothing that was performing well. Bond markets looked bad. Stock markets looked bad. Then in the 90s, inflation got under control and it fell. Markets were still focused on inflation, but in a positive way. Inflation was under control, and in that decade of the 80s and the 90s, both stocks and bonds did extremely well. So anytime markets are thinking about inflation, you'll see a higher correlation between stocks and bonds. When markets are worried about inflation, stocks and bonds both do badly. When the markets are glad inflation has been solved, both stocks and bonds would do well. You can almost not make a mistake in those markets. Since the 90s, for the last 25 years or so, there's been a very low correlation between stocks and bonds because no one's really been worried about inflation. And in that case, stocks and bonds have been a great diversifying asset class. And in that case, stocks and bonds have been great diversifiers to each other. You'll notice, though, here recently, an increase in the correlation between stocks and bonds. Why? Because in 2022, inflation suddenly became a huge issue again, and both stocks and bonds did really badly. So if you look at some historical markets, 1973, 1974, that was a market where everybody was talking about inflation, The S&P 500 was down over 40%, and if he owned a 10-year treasury, it would have lost money. The week of 9/11, where we had the attack on the Twin Towers, obviously a terrible week for markets. Stock markets were down over 10% that week, but treasuries were a place of protection where you could go and park your money while you waited for the crisis to end. Treasuries were positive that week. In 2008, the terrible financial crisis, that was a period of time where people were not talking about inflation or talking about a major recession. In that year, stocks were down almost 40%, but if you had owned treasuries, they would have provided great diversification to your portfolio. They would have been up more than 10%. But then in 2022, when everybody was worried about inflation, there you saw both stocks and bonds were down about 20%, a really terrible, terrible year. And that brings up the point that if all you are investing in is stocks and bonds, you're well diversified except when inflation is an issue. So you're well diversified in a year like 2001, where we had the Twin Towers attack, or in 2008 when we had the financial crisis. In that case, having a portfolio of stocks and bonds, you will have good diversification. But in a year like 2022 or 1973, 74, when everybody's worried about inflation, bonds will not be a good diversifying asset. To bring this home again, this is a somewhat complicated chart, but I just wanted to contrast 2008 to what's happened in 2022. And I want to look at three types of bonds. When we say bonds, not all bonds are the same. So in 2008, long treasuries, long-term treasuries, they were up an amazing 61%. If you had owned 20-year, 30-year treasuries in 2008, you would have made a lot of money on treasuries that year. But corporate bonds and high-yield bonds, corporate bonds are medium quality, high-yield bonds are low quality. They were down a significant amount in 2008. This is important because when most people talk about bonds, most people are not buying treasuries. Most wealth managers do not like to put money into treasuries. They put money into corporates and high yield. And so if you're thinking in a year like 2008, oh, I had bonds that would protect me, that's only if you had treasury bonds. If you had corporates and high yield, they would not have protected you. But then we get to a year like 2022, you can see long treasuries through October were down 46%. They were a terrible place to be. You do not want long treasury bonds if inflation's an issue. They've somewhat recovered back through June, but terrible, terrible asset class. Corporates, however, they were down, but they were not down nearly as much as treasuries and high yield. Interestingly enough, high yield was actually down the least. Why? Because high yield is not as sensitive to inflation as treasuries are. So when we're talking about diversification, when you're talking about bonds in particular, you need to ask the question, which bonds? Treasuries are great at a crisis, but terrible with inflation. High yield does terrible in a crisis, but holds up okay when inflation's the issue, at least relative to the other bond classes. What happened in 2023 over 8 days that I thought was very, very interesting. So in 2022, we saw that stocks and bonds were highly correlated. They both fell a lot. But in March of 2023, stocks and bonds for 8 days went exactly the opposite 8 days in a row. On March 13, stocks were down, bonds were up a bunch. The next day, stocks were up, bonds were down. The next day, stocks were down, bonds were up. Then stocks up, bonds down. You can see a big switch. So negative correlation. Why? Because in March, we've got new information that inflation might be coming down, that the Federal Reserve was finally controlling inflation. And the bond market and the stock market started focusing on the economy. Was the economy going to have a hard landing, which means a really bad recession, or a soft landing? a recession, but a very mild recession. Anytime we got news saying we're going to have a mild recession, stocks did well and bonds sold off. Anytime we got information that said it was going to be a very bad recession, stocks sold off and bonds did well. So that was a good indication those 8 days that the markets were less focused on inflation and more focused on the economy. The next thing I want to talk about is standard deviation correlation, specifically in a crisis. I alluded to it a little bit earlier, but I want to show you specifically when you're using standard deviation as your measure of risk, how well does it do in a crisis? And what happens in a crisis like 2008, which is the perfect example, from September 2008 to February 2009, and February 2009 was the bottom of the stock market. Stocks lost a lot more than standard deviation would have indicated. Standard deviation would have said what happened in 2008 was really unheard of. It should not have happened. One way to consider this is to look at what we call 8 sigma days. And 8 sigma days means that you're 8 standard deviations from the expected value. Sigma is another word we use for standard deviation. If you haven't had statistics, that may not make sense, but let me tell you, an 8 sigma event, something that is 8 standard deviations from the expected value, that is essentially an impossibility. According to basic statistics, 8 sigma days should never happen in our lifetimes. And you can see in the 1950s, the 1960s, the 1970s, the 1990s, and the 2010s, those 5 decades, we had no days that were 8 sigma days. However, in 1980, we had 3 days. That was during that October market crash, and where the market fell 23% in one day and then fell a few days around that. In the 2000s, because of the 2008 crisis, we had 5 days, which would have been 8 sigma days. I remember that. That was the year before I retired. Very, very stressful day to be in the markets. And then in the 2020s, we actually had 4 days because of the pandemic, all in 2020. Next, let's look at some specific times in history that were particularly bad. What about the week of October 19th, 1987? How did individual stocks do there? I have a list of several individual stocks. I have their tickers, so you can probably recognize most of these stocks. The bottom line is the S&P 500. You can see that week of October 19th, the S&P was down over 10%. Now, it fell 23% just on October 19th. So it did recover quite a bit the rest of the week, but you can see that week there were only 2 stocks in my list that were up, AT&T and Exxon, and they were only up a little bit. Texas Instruments was down almost 40% that day. The week of October 6, 2008, during the financial crisis, you can see every stock was down that week. The S&P 500 was down over 15%. Ford was down over 50%. But almost no place to hide that week. Very difficult week. And then the week of the pandemic, March 6th, everything was down. Even Walmart, the third from the bottom, Walmart was down a fraction that week. The only stock that was up was NEM, which is a gold stock. So gold stocks did well that week because gold is considered a place to be during a crisis. You really do not have many places to hide, even with a well-diversified stock portfolio, if the markets are just tanking. Diversification works well, except in a crisis. And in a crisis, you're probably just going to lose money. In 2008, we saw that you lose money on stocks, but if you had long treasuries, you do okay on the long treasuries. But then in 2022, you would have lost money in stocks and in long treasuries. There are just times where all of this diversification and correlation and efficient frontiers, there are just times where markets do the extreme, and you have to be ready to lose money in those markets. So what's one thing you can do to maybe help protect yourself when you see markets moving in radical ways? And there's something we have in finance that we call reversion to the mean. What reversion to the mean implies is if an asset class moves dramatically in one direction or the other. So let's say stocks been up dramatically for 10 years like they were in the 1990s. When stocks do a radical shift up over several years, we think there's going to be a reversion. They've been well above average. Another word for average is mean. They've been well above average for several years. So we believe they may revert to their mean. That means if they've been above average for several years, they'll probably be well below average for several years. And we saw that with the stock market after the roaring 1990s, that we saw in the 2000s, in the year like 2000 where the dot-com stocks crashed, and in 2008 in the financial crisis, we saw stocks having 2 terrible years after that decade where they just did nothing but go up. The opposite is also true. If you see stocks do really, really badly for a period of time, well below average, you might expect them to do very, very well above average going forward. So after the 2008 crisis, you saw the stock market do really badly for 8 years there with both of those crises. That was a great time to get into stocks because of reversion to the mean. So where can we find some reversion to the mean opportunities? Where have asset classes done particularly well for too long that we think they may underperform for a while? Or where have asset classes done particularly poorly where we think they may actually outperform for a time? One place you can go that is interesting is GMO. If you go to their website, you can register, and they have this file that they provide to anyone that's registered where they have a forecast over the next 7 years of what they think certain asset classes will do net of inflation. So these are not their expected returns. These are not their expected returns. These are the expected returns over inflation. So you can see they think U.S. large stocks are going to underperform inflation the next 7 years. But they think emerging market value stocks, which is a hard asset class to buy because there are not too many opportunities there, but if you can find someone managing an emerging market value fund, they think they will dramatically outperform inflation. On bonds, they think U.S. bonds will just barely give you inflation. They think emerging market debt will beat inflation by quite a bit, so you can think they think emerging market debt will outperform inflation by quite a bit. So you can see GMO is very high on emerging markets, both equities and debt. But anyway, that's one perspective. And their approach is very much a reversion to the mean. They tend to find asset classes that have underperformed, that they think are due for a turnaround, which is what they believe about emerging markets, or markets that have outperformed that they think are going to underperform going forward, such as U.S. large cap stocks. So consideration or reversion to the mean, there's a few places you can look at. You can look at overall valuations. Where are stocks and bonds today? You can look at growth stocks versus value stocks. That's an opportunity. You can look at overall volatility, and I'll talk a little bit about that. You can look at corporate spreads. That's just 4 areas. There's many, many other areas. I could talk about large cap stocks versus small cap stocks. I could talk about U.S. stocks versus developed market stocks. But I just want to show you 4 of them, places you might look to get places you might look for opportunities. That's why I gave you GMO. That's one of the things they do is they look for potential That's why I gave you GMO. They're famous for identifying potential market bubbles, markets that are going to blow up going forward because they've overdone their performance. They've risen too fast for too long, and their valuations do not make sense. So just to give you a few quick examples, let's look at overall valuations. So here's something you can use. It's called here's something you can use. Robert Shiller, Shiller. If if you do Robert Shiller data, you can get this Excel spreadsheet for free, and he shows you where he thinks stocks and bonds are relative to valuation. The blue line is where he thinks stocks are. The higher the blue line, the more expensive he thinks stocks are. So you can see in 2000, before the 2000 cry. So you can see in 2000, before the 2000s. So you can see in 2000, before the 2000 market crash, he thought stocks were extremely expensive. If you had listened to him then, you would have done really well because you would have avoided stocks before they crashed. Before the Great Depression, he showed stocks were extremely expensive back in 1929, so you could have gotten out there. At the end of 2008, he thought stocks were actually pretty cheap, so you could have gotten into stocks then, and that would have really done well for you. But then, right before the pandemic, he showed stocks were extremely expensive. Actually more expensive than they were in 1929. Not as expensive as, even more expensive than they were in 1929. Not as expensive, even more expensive than they were in 1929. Not as expensive, even more expensive than they were in 1929. Not as expensive as they were in 2000, but pretty expensive. Now, did he know the pandemic was coming? No, he just thought stocks were extremely expensive. For bonds, it's the exact other way around. With the red line with bonds, and these are treasuries, when the line is low, he thinks bonds are extremely expensive. So back in 2020, when interest rates fell so low, he said bonds were terribly overpriced, terribly expensive, and he was exactly right. That would have been a place where you would have gotten out of long treasuries and avoided the sell-off in long treasuries. We saw long treasuries sold off a lot in 2022. Now he's saying treasuries are well priced. They're not too far off of their long-term history. They're not as cheap as they were in the 1980s, where you could buy a long treasury yielding 18%. That would have been a great time to buy a long treasury, and you would have had 18% guaranteed for 25 years. They're not that cheap, but they're not as expensive as they were. They're a lot cheaper today than they were, say, 20 years ago. They're a lot cheaper today than they've been over the last 20 years. Another way to look at this is something called the PE ratio versus inflation. I have not updated this in a while, but it does go through 2022. And what this shows you is these blue dots are the PE ratios of the S&P 500 relative to inflation, CPI. And what we know historically is when inflation is high, like at 15%, PE ratios should be low. A PE ratio measures how expensive the stock market is. When PE ratios are low, the stock market is cheap. In fact, Robert Shiller is using something very similar. It's a PE ratio adjusted for inflation. So in the 1980s, early 1980s, inflation was high, but stocks were also very cheap because of that. When inflation is low, as we've seen the last several years, stocks become much more expensive. But sometimes they get way too expensive. So here inflation was low, so PE ratios should be high, but they should not have been this high. This is the dot-com period where stocks got really, really expensive. So you want to stay somewhere close in this area here. These green dots, the stock market looks really expensive here. Why? Well, here you see the green dots not much more expensive than here, but inflation is much higher. And because inflation is much higher, the stock market looked really expensive. Now inflation has come down, so these dots are moving left. So the stock market doesn't look too bad because inflation has come down. But what this is telling us is if the Federal Reserve did not fix inflation, the stock market in the U.S. was extremely overpriced. In the 1970s, we saw that inflation did not get solved, and stock markets were grossly overpriced because of that. Fortunately for us, inflation has been coming down, and if that's the case, maybe stocks were not that expensive. Back up here, you would have been pretty worried. The stock market relative inflation was extremely expensive, and you might have pulled out. And if you'd done that, you probably would have saved yourself some money, but your problem would have been the Fed fixed inflation pretty quickly, or at least we think they have. We'll see. Some of you watching this video a few months from now might say, whoa, he got that wrong. Inflation popped back up. But as far as we know, at the time I'm doing this video, things are looking much better. So there are things you can look at to try to say, wow. So there are things you can look at to try to see, wow, is this a good time for me to be in stocks or a bad time? If it looks like a bad time because you're way up here, you might say, okay, my model says to put 70% in stocks, but I might only do 40 or 50% right now. I might pull back. Other things you can look at is the stock market relative to our economy, stock market capitalization, how expensive are stocks, and you can see stocks look pretty expensive relative to our economy. So that's a little worrying. Corporate profits as a percentage of our economy also look expensive. So there are some signs that the stock market, there are signs that the U.S. stock market looks expensive. That is one reason why your wealth manager may be pushing you toward non-U.S. stocks, because you do not see this with European stocks and other developed market stocks. Japan, Europe, Australia, they don't look as expensive relative to the U.S. stock market. This next one shows you interest rates. You can see back in 2020, interest rates looked really, really low. And if your model said put 40% in bonds, you might have said, you know what, I'm not going to do 40% in bonds. I might move more of the cash and just hold cash until interest rates come back. I actually, in 2020, when interest rates hit that low, instead of buying treasuries, I actually bought a short treasury fund. A fund that when interest rates rise, it would make money for me. It was as if I were selling 20-year treasuries. So if you buy 20-year treasuries and interest rates rise, you lose money. But I was actually shorting 20-year treasuries. And so I made 20, 30% on that fund as interest rates rose because I saw interest rates were so low. Here you can look at interest rates on a shorter term basis. I only go back to 2014. You can see interest rates have risen quite dramatically. You don't see it as much in the previous chart because that's a much longer history. But even then, it does stand out that interest rates have risen sharply. Now, you notice in the 70s, they rose much more sharply. So if the Fed doesn't fix the inflation problem, you can see interest rates dry. So if the Fed does not fix inflation quickly, you could see interest rates rise quite dramatically. But here recently, you can see in 2023, interest rates have essentially gone sideways. If you look at it on an inflation basis, these are TIPS, inflation-linked bonds. So this is the return you get plus inflation. You can see TIPS actually had a negative yield, which means you get negative 1% plus inflation. Who would buy that? I would not buy that bond at all. Inflation-linked treasuries are back to more normal levels at 1.5%, so you get 1.5% plus inflation. I remember back here when TIPS hit 3%, and unfortunately I was still a portfolio manager, so I was really restricted on what I could buy, but I was very tempted to buy, but I was very tempted to put a large amount of my portfolio into TIPS because to get 3% plus inflation on a risk-free basis, that would have been a really great investment. So if I see TIPS get above 2.5% again, 2.5% treasuries, so low-risk bond, plus inflation, that sounds like a really good deal to me. So I like to watch these interest rates. Here are TIPS on a more recent basis. You can see TIP yields have risen back really to more normal levels. 1.5% is a more normal level. So that means TIPS are an interesting buy again. They're not a screaming buy right now, but they're interesting. But just another way to look at markets. The next area you might look at if you want to deviate from the efficient frontier is growth stocks versus value stocks. Growth stocks are those stocks that are growing very fast and they're very expensive. And we've seen here recently, growth stocks have really dominated the stock market. Here I'm looking at a few stocks: Apple, Microsoft, Amazon, Google or Alphabet, Netflix, Tesla, Meta or Facebook, and Nvidia. These stocks have really driven the market much higher. You can see their mix of the market in the orange versus the blue, which is the rest of the market. You can see, especially going into 2021, they really dominated the stock market. This shows you the percentage those stocks are of the whole stock market, and you can see at the end of 2021, they got to be almost 29% of the stock market. And then they sold off a lot in 2022. But what is surprising is going through the first half of 2023, they've come roaring back, and now they're actually a larger percentage of the stock market than they were at the end of 2021. It's hard for me to find another period in time where so few stocks dominated the market this much. Maybe energy stocks in the 70s. It's hard to say, but this is probably a fairly unusual period of time where a few growth stocks really dominated the market. I'm not going to read through this article, but I gave you the example of GMO as a good source to go look at for some ideas. And they've had several articles on value versus growth that I think are very interesting. They address what I talked about with value and growth, that growth tends to do well in weaker economies and when interest rates are low, and that's because growth stocks are higher quality companies. Value stocks tend to do better in stronger economies and when interest rates are higher. If you look at 2022, we had a point in time where interest rates rose dramatically, and as such, value outperformed growth just like you would expect. So the big question is, are we going to have interest rates still keep rising, which would be bad for growth stocks? Are we going to go into a recession, which would be bad for value stocks? But GMO says it doesn't matter, and the reason they say it doesn't matter is the relationship between value and growth stocks and recessions and interest rates is not as strong as some say, such as what I was saying in the previous video. But they also argue that value stocks are so incredibly cheap versus growth stocks that it almost doesn't matter. They're so cheap, even with a recession, even if interest rates were to fall, you would expect to see value outperform, especially over the next 5 to 10 years. And they say they're not as cheap as they were in 2000 when the dot-com growth stocks really took off, but they're in that neighborhood. They're fairly cheap. So I'll let you read this article on your own. You'll have no trouble finding it if you register with GMO. They have several other articles, even more recent than the one I'm showing here, on growth versus value. And they have other ideas also related to where are there opportunities today in the market. Another idea related to reversion to the mean is volatility. Volatility is how volatile is the stock market. And one good way to measure that is something called the Volatility Index. You can look this up on Yahoo Finance. Just do Shift 6, which is the little caret, and type V as in Victor, IX, and that gives you the VIX. The VIX is not the volatility of the stock market historically, but what is expected to be the volatility over the next 3 months. It is highly correlated with current volatility, but it really is a forecast of what people think going forward. My idea on VIX is it's normally around 18%. If it gets well above 30%, then the VIX is very high, and that might be a good point to buy stocks because they probably have oversold. You can see when the VIX hit its high in early 2009 or late 2008, and when it hit its high in 2020, those were both great times to get into the stock market. When it goes to an extreme like that, those are good times to get into stocks. When it's extremely low, like it was in 2018 or in 2007, I believe those would be periods of time where the stock market is probably a little dangerous, because what that means is the stock market is not focused on risk. People have become what I would call complacent. And that is worrisome to me as an investor. If people are not worried that something could go wrong, they're probably overpaying for stocks. Right now, as at the time I'm doing this in mid-2023, the VIX is unusually low, dropping down below 15. It's not extremely cheap, but it is unusually low. My idea is when it drops below 10, I do what's called option contracts. That's something that's well beyond this video, but when the VIX is very low, option contracts, which are essentially buying insurance on the stock market in case it crashes, that insurance is very cheap when the VIX is low. And so I'm starting to get interested in some option trades that I think would be very lucrative. I've done that in the past and it has worked really, really well, buying options when they're very, very cheap. When the VIX is above 45 or above 40, there you're probably in a crisis. Something really bad has happened. And that means people are extremely worried. When people are extremely worried, they probably have oversold stocks and they're probably cheaper than they should be. So right now, we're getting into the point where the market is probably a little too complacent. Might be a time, instead of looking at the efficient frontier that says you should have 70% in stocks, maybe you would cut back some until the VIX gets back to normal. I don't think we're quite to that level where it's unusually low, but if we get down to 10, I'm very worried about stocks when the market is that complacent. A final thing you consider is spread. A spread is how much corporate bonds yield or what return they provide over treasury bonds. Treasuries are considered risk-free by many people because the federal government can print their own money, so they should not have any trouble paying their debts, whereas corporate bonds can default, and so you should get paid an extra return for taking that default risk, and that's called a spread. You want to know, are spreads really large, or what we call wide in finance, or really narrow, or really small? I don't know exactly when I pulled these numbers, sometime in early to mid 2023. I should have put a date on here. But you can look at this chart and see that today spreads are really pretty narrow. They have not gapped out that much. So the very bottom line shows you current spreads. We start from the left to the right with high quality AAA. The spread is 0.24%, or what we call 24 basis points. You can look at the top line. The average is 30. So right now we're at 24 versus 30. The median is 24. So 50% of the time it's above 24, 50% of the time it's below 24. So we're right at the median, but below the average. The reason the median is lower is because in a crisis, the spread really gaps out a lot, so it skews that average to the higher number. AA as well is below its average, but slightly above the median. Single A is right at its average and a little bit above the median. Triple B, again, below its average, but above the median. And to me, the most concerning is high yield, which is really right in line with its history, below its average, but above the median. This is not a time where corporate bonds look particularly cheap. They don't look expensive, but they don't look cheap. My concern is we're in the middle of 2023 when there's a lot of uncertainty. People are talking about a possible recession. Obviously, you would not want corporate bonds, especially the triple Bs or the BAAs and high yields if you're expecting a recession. And yet those bonds are not paying you much more than they have historically. So it's not a great time to get into bonds. However, if you see these spreads gap out to historical highs, like in 2008, you notice they all hit their max in November of 2008. That was actually a great time to be buying triple B bonds and high yield bonds. High yield bonds, if you had bought them at the end of 2008, you would have made 70% on high yield bonds in 2009. So that was a great time to be buying bonds because the market was just frozen. There were no buyers, so if you had been a buyer, you would have been buying in a buyer's market. When there were no buyers, a lot of sellers, you would have gotten bonds at really great prices. So probably no great opportunity right now. It doesn't really mean you should avoid corporate bonds, but it's not a strong argument that you should over-allocate to them. But these are just a few examples of places you might look if you want to see, do I really want to go with the efficient frontier? The efficient frontier is a long-term analysis. Those allocations we looked at in the previous video, they assume a long-term expectation, but the long-term is maybe 20 years, 30 years. But if there's something unusual going on right now, you might vary from that. We'll talk about that much more in the next series of videos where we talk about execution. That's where you'll have to make the decision of how tactical do you want to be? How much do you want to vary from that efficient frontier. So I'll show you exactly how to look at it, but I'm giving you some ideas here. There's obviously a lot more ideas that I mentioned earlier, and you have to decide if you're smart enough or have enough data access to actually make decisions where you want to deviate from your strategy.